Something happened last night that has not happened in nearly 6 years. Oil crashed 18% in a single session. Not over a week, not over a month, overnight. If you woke up Wednesday morning and checked the news, you saw the headlines: ceasefire, market surge, oil plunges, relief rally. And if you're like most people, you read those words, felt a vague sense that something good had happened somewhere, and then got on with your day without fully understanding what any of it means for you personally. That's exactly what this video is going to fix. Because here's the thing about an 18% crash in oil prices. On the surface, it sounds like good news, and parts of it genuinely are. But underneath that headline number is a more complicated, more interesting, and frankly more important story. One that directly determines how much you pay for fuel next week, how much your groceries cost next month, and whether the relief you're about to feel in your wallet is real and lasting, or temporary and misleading. By the end of this video, you are going to understand exactly what happened, exactly what it means for your money right now, and exactly what is coming next that the relief rally headlines are not telling you. Let's go. First, let's establish what most people think when they hear oil prices dropped 18% overnight. The natural assumption is straightforward. Oil is cheaper. Petrol will be cheaper. Everything that depends on oil will get cheaper. Life gets a little easier. The pressure on my budget eases. Good news. And that assumption is partially correct, but it is missing 3 things that completely change the picture. The first thing it's missing is context. Where did oil prices come from before they crashed 18%? Because a crash sounds dramatic until you understand what it crashed from. The second thing it's missing is timing. How quickly does an oil price move translate into prices you actually feel? Because there is a gap, and that gap works very differently depending on whether prices are rising or falling. The third thing it's missing is permanence. Is this a new floor for oil prices? Or is this a temporary relief bounce in the middle of a structural price shock that has months left to run? Understanding all 3 of these things is the difference between making smart financial decisions in the next 30 days and being surprised all over again when your expectations don't match reality. So let's build this out properly, layer by layer. Let's start with the context problem. Before the US-Iran war began on February 28th, oil was trading at approximately $67 a barrel. That was the baseline, the pre-war normal. Over the following 40 days of conflict, oil surged to a peak of $117 a barrel. That is a 74% increase in less than 6 weeks, one of the fastest and most severe oil price spikes in modern history. The International Energy Agency officially described the supply disruption caused by Iran's closure of the Strait of Hormuz as the largest in the history of the global oil market. Now the ceasefire was announced. Oil crashed 18% overnight. Dramatic. Historic. The biggest single-day oil price drop in 6 years. But here is the number that matters. After that 18% crash, after the biggest one-day oil price drop in 6 years, oil is still trading at approximately $92 to $96 a barrel, still roughly 40% above where it was before the war started. Read that again. The biggest oil price crash in 6 years, and oil is still 40% more expensive than it was 40 days ago. That is the context the headlines are not giving you. The celebration is real, the relief is real, but the baseline has shifted dramatically, and an 18% recovery of a 74% spike is not a return to normal, it is a partial unwinding of an extreme. Think of it this way. Imagine someone raised the price of your daily coffee from $4 to $7. Then one day, they dropped it to $5.80. You would not feel like you were back to normal. You would feel like it was slightly less expensive than yesterday, but still significantly more expensive than it used to be. That is precisely where global oil prices are right now. And that gap, between where prices were before the war and where they are today, is the most important number for your wallet over the next 3 to 6 months. Now let's talk about timing, because this is the part that consistently surprises people. When oil prices rise, how quickly do you feel it? Almost immediately. Petrol stations reprice their forecourts within 24 to 48 hours of a significant crude oil movement. Supermarkets that have locked in short-term supply contracts feel it within days to weeks. Airlines adjust fuel surcharges within weeks. Manufacturers revise their input cost projections within the same quarter. The transmission from crude oil price to consumer price on the way up is fast. Now, here is the asymmetry that most people don't know about. When oil prices fall, how quickly do you feel it? Much more slowly. This is not accidental. It is structural. And it has a name in economics: rocket and feathers pricing. Prices go up like a rocket and come down like a feather. When crude rises, retailers pass the increase on immediately. When crude falls, they pass the decrease on gradually, absorbing a portion of the margin improvement themselves before it reaches consumers. Studies consistently show that a $10 per barrel rise in crude oil reaches the petrol pump around twice as fast as a $10 per barrel fall. So what does this mean for you right now? It means the 18% overnight crash in oil prices will reach your petrol pump. Not overnight, over days and weeks. And it will not come through fully. A portion of the margin will be absorbed by producers, distributors, and retailers who spent the last 40 days managing razor-thin profitability at elevated costs. It means your grocery bill, which absorbed weeks of upstream cost increases across fertilizer, shipping, packaging, and transport, will not suddenly reset. Those costs were already priced into supplier contracts, distributor agreements, and shelf pricing decisions that don't reverse on a Tuesday night because a ceasefire was announced. The good news will reach you, but it will arrive slowly, partially, and unevenly, depending on what you're buying, who's selling it, and how competitive your local market is. Now let's talk about the ceasefire itself, because understanding what it actually is versus what it sounds like is critical to understanding how permanent this relief will be. The ceasefire announced on April 7th is a 2-week pause, not a peace treaty, not a resolution, not a diplomatic settlement. A 2-week pause in hostilities, brokered by Pakistan, contingent on Iran reopening the Strait of Hormuz to commercial shipping under Iranian military coordination. 2 weeks. After those 2 weeks, US and Iranian delegations are expected to meet in Islamabad to negotiate a larger agreement. Those negotiations will need to resolve, among other things, Iran's right to nuclear enrichment, the lifting of international sanctions, the withdrawal of US forces from the region, compensation in the form of reparations, and the permanent status of the Strait of Hormuz. These are not small items. These are the core issues that have driven US-Iran tensions for decades without resolution. And here is what market analysts are already saying about the durability of this truce. Experts at BCA Research have warned that the ceasefire could derail later this year, or even later this month. The Economist Intelligence Unit described the arrangement as a pause in the conflict rather than any kind of lasting resolution. Lloyd's of London, the global hub for maritime shipping insurance, stated directly that it is highly unlikely that trade into the Gulf will simply resume, and that the region remains at heightened risk, with none of the underlying tensions resolved. Meanwhile, Iran itself has been sending contradictory signals. While its foreign minister confirmed the ceasefire, the Supreme National Security Council declared that their hands are on the trigger and that the moment the enemy makes the slightest mistake, it will be met with full force. The markets heard ceasefire and responded with relief. The analysts are responding with cautious optimism, bordering on structured skepticism. The insurance markets are responding with continued elevated premiums. All three of those responses are rational. They are just operating on different time horizons. And for your wallet, the time horizon that matters is not the next 24 hours. It is the next 3 to 6 months. Here is the part of the ceasefire story that the relief headlines are almost entirely ignoring. There are 3 structural damage points from this 40-day war that do not recover because a ceasefire was signed, and each of them has a direct, ongoing impact on your everyday costs. The first is the Ras Laffan facility in Qatar. Iranian strikes early in the war knocked offline the world's largest liquefied natural gas export complex. Qatar Energy has stated that repairs are expected to take 3 to 5 years. This facility produces helium as a byproduct of natural gas processing, and Qatar supplies approximately 1/3 of the world's helium. Helium is an essential input for semiconductor manufacturing. Every chip in every phone, laptop, car, and appliance runs through a production process that requires helium. A ceasefire does not rebuild a destroyed industrial complex. 3 to 5 years of reduced helium supply means 3 to 5 years of upward pressure on chip manufacturing costs, which means upward pressure on the price of every tech product every smart appliance, and every piece of manufactured goods that contains a circuit board. The second is fertilizer. Approximately 50% of global urea and sulfur exports normally transit through the Strait of Hormuz. Even with the strait reopening under the ceasefire, the disruption to the current planting season has already happened. Farmers who needed fertilizer inputs in March and April, right now, either paid dramatically elevated prices or planted less. The harvest consequences of that decision will show up in food prices across 22,260. A ceasefire cannot reverse a planting decision that was already made under duress. The third is shipping confidence. Even as the strait technically reopens, commercial shipping operators and their insurers are not going to immediately return to normal operations in a region that was actively targeted for 40 days. War risk premiums will remain elevated. Shipping backlogs, vessels that rerouted around Africa rather than through the Gulf, will take weeks to months to clear. The supply chain does not snap back to pre-war efficiency the moment a ceasefire is signed. These three structural damage points are the reason economists are warning that energy and commodity markets will remain on a structurally higher floor. Their exact words, well above pre-war levels even in a scenario where the ceasefire holds and shipping fully resumes. Let me zoom out for a moment and show you the bigger pattern here. What we are watching in real time is something that financial historians call a supply shock with a long tail. A supply shock is when a sudden disruption removes a significant portion of a critical commodity from the global market. They are dramatic, fast-moving, and they generate immediate price spikes that capture everyone's attention. But here is the part that most people don't understand about supply shocks. The initial shock is the visible part. The long tail is the invisible part. And the long tail is almost always more expensive than the shock itself. It just arrives more slowly, more quietly, and across a wider range of products. The 1973 oil embargo is the most famous example. The embargo itself lasted about 6 months, but the inflation it triggered, flowing through food systems, manufacturing costs, shipping rates and interest rate decisions, took nearly a decade to fully work its way through the global economy. The visible crisis ended relatively quickly. The economic consequences ran for years. We are not in 1973. The world's energy systems are more diversified, more resilient, and more adaptive than they were 50 years ago. But the underlying mechanism, supply shock, creates structural price floor that persists long after the triggering event resolves, is the same. The 18% oil crash overnight is real. The ceasefire relief is real. And the structural price floor that this 40-day war has built into global energy and commodity markets is also real. All three things are simultaneously true, and your wallet will feel all three of them over the next several months. The partial relief first, the structural persistence second, and the long-tail price effects last. Let's get specific, because abstract economic analysis is only useful if it connects to decisions you can actually make. At the petrol pump, prices will come down from their peaks. They will come down over the next 2 to 4 weeks as the oil price crash filters through to retail fuel pricing. But based on where crude is currently sitting, still roughly 40% above pre-war levels, expect petrol prices to remain significantly elevated compared to February. Not at war peak levels, but not at pre-war levels either. Somewhere in between, drifting down slowly over weeks. At the supermarket, your grocery bill will not respond to the ceasefire the way your stock portfolio did. The upstream cost pressures, fertilizer, shipping, packaging, distribution, were built into supplier pricing over weeks and will unwind over months. Expect modest, gradual improvement in some categories. Expect continued elevation in others, particularly fresh produce, grains, and anything with complex international supply chains. The fertilizer story alone will keep food costs above pre-war levels well into 2027. On your energy bills, natural gas prices, which surged 61% during the war, will ease but, like crude oil, are unlikely to return to pre-war levels quickly. The Qatar LNG facility damage means global LNG supply is structurally tighter for years. European gas prices, in particular, will remain under pressure as the continent that was most dependent on Gulf LNG faces a multi-year rebuilding challenge. On manufactured goods, this is the slowest moving and least visible impact. The helium shortage and its semiconductor consequences will not show up in your phone upgrade cost this month. But over the next 12 to 24 months, as existing chip inventories are drawn down and production constraints bite, The cost of electronics, appliances, and vehicles will face upward pressure that traces directly back to the Ras Laffan strikes of February and March 2026. 3 things you should do differently with your money right now given everything we've covered. The first is to recalibrate your expectations deliberately. The biggest financial mistake people make after a relief event, a ceasefire, a market recovery, a policy announcement, is assuming that the new lower number is the new normal floor. It isn't. Oil at $92 is not the new floor. It is a post-ceasefire position within a range that is still 40% above where it was 6 weeks ago. Plan your household budget around a fuel and energy cost that is meaningfully higher than pre-war levels, because the structural damage to supply chains makes a full reversal unlikely in the near term. The second is to take advantage of the next 2 to 4 weeks. As oil prices filter through to retail fuel, there will be a genuine window of lower pump prices compared to the peak of last week. If you have a vehicle, if you use fuel regularly, the next month represents a relative discount compared to where prices were at the height of the conflict. Use it. Fill up when you can. But do not confuse a temporary discount from a spike with a return to the pre-war normal. The third is to separate the stories inside the big story. The oil price is one story. The fertilizer disruption is a different story with a different timeline. The helium and semiconductor story is a third story with a third timeline. Each of them will affect your wallet differently, through different products, with different lags. Understanding them separately lets you anticipate which costs are coming down now, which are stabilizing, and which have not yet fully arrived. Most people are watching one headline. The people who manage their money well through periods like this are reading all 3 chapters simultaneously. Last night, oil crashed 18%. This morning, headlines declared relief. Markets surged. People exhaled. And all of that is real and worth acknowledging. A ceasefire after 40 days of the most severe global energy disruption in recorded history is genuinely significant. But you have now seen what the headline doesn't show you. You've seen that oil is still 40% above where it was 6 weeks ago. You've seen that prices come down like a feather after rising like a rocket. You've seen that a 2-week ceasefire is not a peace treaty, and that the structural damage to fertilizer supply, helium production, and shipping confidence will take months to years to fully repair. And you've seen that your wallet, your petrol pump, your grocery bill, your energy costs, sits at the end of a long, invisible chain of connected events that runs from a 33-kilometer straight on the other side of the world through commodity markets, insurance pricing, shipping backlogs, and supply chain decisions all the way to the number on your receipt. The relief is real, the work is not over, and now you know the difference. That is worth more than any headline. Think about it.